Well, friends and family, my name is Amos, and it's finally time. I'm going to be revealing my $1 million portfolio. Actually, it's 1.07 million to be exact. I hate to be that guy, but I'm just kidding. My actual portfolio is only a fraction of $1 million, and that's coming soon. Very soon. But in all seriousness, today we're going to be taking a look at Bob's portfolio. And I am very delighted and excited to say that he's getting the very first portfolio review and roast. So who exactly is Bob? Bob is currently 33 years old, and he only had $1,000 to his name when he came to the US. And now he's a multi-millionaire from his business operations of baked potato food trucks. Yes, friends and family, with enough grit, determination, and hard work, you can become wealthy in the US in almost any line of business. But anyways, he runs 5 trucks across 3 different cities, and when he's not topping potatoes with sour cream and bacon bits, he's topping up his brokerage account with high-quality dividend stocks. So when it comes to Bob, what exactly is his portfolio strategy? Well, what you see on your screen right now are the actual holdings of his portfolio. $1.07 million, that's the current valuation. And the strategy is to accumulate safe and steady dividend payers that have an economic moat. And the portfolio's goal is very simple. At least 7% portfolio growth year over year, and that's just taking into account the share price appreciation, and to generate at least $40,000 a year in dividends, because Bob shared with me that he plans on retiring next year. And when it comes to the dividend growth rate, he wants at least 7% year over year. So it looks like 7 is his lucky number. He probably has 7 kids as well. And his portfolio currently has 20 different holdings, and it generates about $37,500 in dividends a year. And the portfolio's current yield is 3.48%. So after taking some time with sitting with his portfolio and looking at the holdings and reviewing what's in it, let me just make it a little bit bigger so it's easily, there it is. Here are my takeaways, opinions, and thoughts. The biggest holding in his portfolio is NextEra Energy, a utility. The second biggest is United Health Group. He has 371 shares, average cost basis $296. He has Rexford Industrial, which is a REIT. So in the top 3, he has his bases covered, and it's kind of diversified. You've got a utility, you've got a healthcare player, and then you also have a real estate company. And as you go down the list, I would argue it's pretty good stuff from start to finish. No. The only one that makes me kind of hesitate and pause is this one right here, Plug Power, and I'll be talking more about that in a little bit. But overall, this is what I could say. I could definitely see that while I compile this portfolio, I wore my value investing hat. I'm just kidding. This is Bob's portfolio, and that's probably what his thought process was. He applied the principles and lessons of value investing, because every single one of these stocks that you see on your screen right now have been beaten up or have gone on a sell-off in the past 1 or so years, including Hershey, including Lockheed Martin, PepsiCo, American Waterworks, Mondelez, and of course, my beloved United Health Group. And what's kind of wild about this portfolio is that there's extra love towards the utility sector. I mean, we have NextEra right here, we have Black Hills right there, we have another utility right here, another one, and another one. So I would argue his portfolio skews towards the utility space, but between you and me, I think it makes sense because it's a proxy for bonds. Not only do you get a very stable and reliable dividend yield that's usually 3 to 5%, but you also get the potential upside of share price appreciation, because a utility stock does grow in valuation in a perfect world, whereas a bond, you're basically just getting that income. So even though personally I wouldn't put this much allocation towards the utilities, it makes sense given Bob's portfolio goals and what he wants. Case in point, if we just pull up some of the utility stocks that he's invested into. The first one is WEC, and we jump on over to his dividend profile. Right now, it's a 3.2% dividend yield that is absolutely sustainable and healthy, and it's growing at a rate of 6.9% year over year, which is just shy of his 7% dividend growth rate that he wants to see, and you want to see it visually depicted. For the past 10 years, despite setbacks, corrections, the pandemic sell-off, WEC utility has been increasing their dividend payment time and time again. And if we look at NextEra Energy, ticker symbol NEE, Next era. There we go. And their dividend profile, it's a 3.2% dividend yield. The payout ratio, absolutely sustainable for a utility. I feel like for a utility, what's healthy, the golden standard, is anything below 85 or 90%. Yes, it's a little higher, but that's because their industry as a whole is regulated for the most part. I think there's only a handful where they're unregulated, but because it's a regulated space, the amount of profits that they can generate per share, it's not going to be bonkers and bananas such as like Nvidia or Apple. Having said that, a 77% dividend payout ratio, meaning from their earnings per share, 77% of it will be utilized to do this right here, to fund the dividends per share, which is $2.27. If I jump on over to the income statement, I'll just show you what I'm talking about. We look at their earnings per share right there, $2.87. Of that, 77% will be used for the dividends, which means they still have about 23% to reinvest back into the business, the operations, to fund their CapEx, to increase the wages of their workers, X, Y, Z. The lower this number, the better it is. For a utility, 77%, dude, that's healthy, it's good. And then their dividend growth rate, my goodness gracious. Dude, we're talking about 10% growth. That is absolutely beautiful. So can you see why he prioritizes and really appreciates the utilities? There are some people out here that dismiss them because of the CapEx without fully understanding that this industry and space, the utilities, they're funded primarily through loans. And I would argue it's probably one of the safest industries out here, especially in comparison to the semiconductor chips, especially in comparison to the biotech stocks. Dude, utilities, they're here today and here tomorrow. You're gonna be paying your electric bills. Do you wanna flush your toilet after you drop a protein bar? Yeah, you're gonna have to pay your water bill. So the utility sector, I think very fondly and highly of, and eventually when I get towards my retirement age, I will be going in heavy to utilities as well. So it makes a ton of sense. And you wanna look at it visually depicted, this is exactly what you wanna see, especially as a dividend growth investor. And then I'll just do one more. Another utility that he's balls deep into is American Water Works, ticker symbol AWK. Awkward. Their current dividend yield, it's a little lower than the first two that we looked at, 2.4%, but I still think that's pretty decent, right? I think it's very subjective in terms of like what is a decent dividend yield, but for me, it's anything above 2%. And the golden standard of like a really pretty, juicy, and beautiful dividend yield is at least 3%. But 2%, it's not bad, I'll take it. Payout ratio, very healthy, but look at the growth rate. 8.1%. And American Water Works is the biggest pound for pound water utility stock that's operating here in the US. And look at it visually depicted. Healthy, sustainable, reliably growing year over year. So I understand why he went so heavy into the utilities, and I can't argue with it. It makes a ton of sense. Now, having said that, personally, whenever I'm sober, I really do not like cyclical stocks because they tend to be an eyesore when they're out of favor. Like when the times are good for them and it's their time to shine, dude, they outperform everybody. But when they go out of the rotation and they're no longer desirable by the markets, it's kind of an eyesore. Now, as a long-term investor, because they operate in a boom and bust cycle in terms of these cyclical stocks, I guess eventually they'll come back into favor, especially if they have a wide economic moat and they're the best at what they do. So even though as of right now they might be out of favor, eventually they'll just come back. If you buy into cyclical stocks, especially when they're in the low end of their market cycle, like if they usually trade for about 50, 60 bucks and right now they're 20 bucks because they're out of favor, I guess it makes sense to buy into them when they're 20 and then they'll rebound back to 50. And I'm not saying past performance is indicative of future gains, but when you look at the oil and gas field, when you look at the hotel stocks, when you look at the commodities field, they go in up and down cycles that tend to be pretty predictable. And so if you just buy and hold these cyclical stocks that you buy on the low, I guess they can reward you with a sweet dividend as you wait for their rebound. And I think there's two that stick out for me. Number one is Marriott Vacations, which is a timeshare company. And I think the other one is down here, FMC, which is one of the biggest players in the pesticide, herbicide, and insecticide business. And it's crazy to say this because I'm a student of the game. I feel like I'm always learning and adapting my mindset and strategy as I learn new things. Like I'm not one of those people that stay confined to their beliefs and methodology, especially especially if there's better ways to do things. And having said that, earlier this year, I learned I'm not really a fan of cyclical stocks, but if you are a long-term investor, especially with a 10, 20, 30-year horizon, I guess it really doesn't matter if they do their little dance in the stock market of going up and down. As long as you just hold and they don't cut the dividend, I guess it makes sense. And in terms of how I would evaluate and grade Bob's portfolio, what you see right there, well, I think for their asset and strategy category, overall, I would give it a B. Just missing the mark of being a B+. I think fundamentally, from 1 to 19, I think number 20 really doesn't belong, but 19 of the 20 stocks, it makes sense. It's just a little concentration heavy with the utilities. So if that sector goes on a sell-off, this portfolio will go deep into the red. But the utility sector does tend to have a little reduced implied volatility. So even if it does go in the red, it's not like it's going to go by 50, 60, negative 70%. You know, it's going to be down by, I don't know, worst case scenario, 30%, 20% if the catastrophic events occur. And in terms of the risk profile, I would argue it's a 2.3 out of 10. I think out of his entire portfolio, there's probably one, maybe two companies that are at risk of cutting their dividends if times get hard. But for the most part, I really do not see Lockheed Martin cutting their dividend, United Health Group cutting their dividend, Next Era Energy cutting their dividend. So as a risk level, it's pretty low, 2 out of 10. So if you have a low risk tolerance, I think this portfolio is a manifestation of that mindset. However, if you're someone that goes gung-ho and all in into option strategies for like Bitcoin, for Coinbase, Nvidia, AMD, this portfolio makes no sense to you because it doesn't have enough adjusted risk for the reward of your preferences. And in terms of the quality of holdings from an A all the way down to an F, I would argue it's a B. And a B for me is pretty darn good. It's above average, and it's probably better than 85 to 88% of other portfolios out there. So that's a really good thing. And I say that because almost every single one of his holdings are best in class with wide economic moats. But I am kind of cautious with how he does have two stocks that are in the pharmaceutical space, which I used to work for as a strategy leader. I'm not really comfortable with them, but I guess he sees value in them. Case in point, Pfizer, he has about $11,000 invested into them. And I think he has one more, the parent company of Ozempic, the weight loss drug. Where is it? Oh, right here, Novo Nordisk. He has about $30,000 invested into them. Those are the only ones I would argue are kind of shaky with the whole wide economic moat situation, especially with the expiring patents and the drug pipeline and R&D that's required for a pharmaceutical to thrive. If you want to know more, watch the video that I made about why I don't invest into pharmaceutical stocks, but it makes sense. They're really beaten up right now, and it's almost to the point where it doesn't make sense. However, I think in terms of the quality of holdings, I really want to mention this because I wrote it in my notes. I think this portfolio is proof in the pudding that you can have a high-quality dividend portfolio without any exposure to big tech, like Nvidia, Tesla, Amazon, because I feel like most people, if they take a look at his portfolio and his age bracket and demographic of being 33, dude, they would scold them and be like, why aren't you invested into Tesla, Palantir? But the thing is, I want to defend them. You really don't have to, because his goal and his priority and his strategy is fundamentally different than someone who's going all out into those quote unquote growth-oriented stocks. Because for Bob, he's focused on income right now. He's eyeballing retirement next year. He's about to press the button and stop working. So instead of getting potential share appreciation through growth stocks, he wants the tangible cash flow pouring in, the passive income. And so I would argue his portfolio makes a ton of sense. And for metric number 4, I'm only going to be applying this to people who submit their portfolios that want dividend income, because I think some people are only going to be invested into growth stocks. So this one won't be applicable. But for Bob, it is. So the dividend sustainability, I would argue it's very healthy. I see absolutely no problems with this portfolio continuing to generate about 3.5% in dividends per year. And I would go as far as to say this is the textbook definition of a sleep well at night type of portfolio. You're not going to be tossing and turning, sweating and being nervous like, is my portfolio going to crash and burn? And I say that because it's not full of speculation or ridiculous stocks. The only one I'm kind of disgusted with is Plug Power, and I think that's the perfect time for us to segue into what I would change. So instead of doing an extreme makeover where we just start trimming and cutting everything, how can we optimize this portfolio without doing drastic plastic surgery like getting fillers all over your face, Botox all over your eyebrows, and getting your chin done? Instead of doing all of that, here's what I would do. First and foremost, if we scroll down right here, I would absolutely get rid of Plug Power. I know right now he's kind of in the red, not by much, but he is in the red. But as soon as it breaks even or even crosses into the green territory, I would say see you later, thank you for your service, because in this portfolio, it makes 0 sense. They do not pay a dividend, their financials are shaky, and they just look and feel different from the rest. I mean, when you think about Plug Power, this is one of those very speculative growth companies. When you compare that to Hershey, when you compare that to the Middlesex Water Utility Company or PepsiCo, I mean, come on, he's in his own little category and ball game. He's just a weird guy. However, I can tell it's just fun money because it's the smallest holding. He only has $1,900 invested into it. But I'm not gonna sit here, judge him, be a hypocrite, and burn him alive at the stake, because me too, in my own portfolio, I also have some speculative growth bets. A very small allocation, mainly the yield max ETFs like Alti and Misty. So how am I gonna sit here and judge someone for putting about $2,000 into Plug Power when I also have a small amount of capital into some very speculative income ETFs? And the next thing that I would do, this is very personal preference. I mean, I can absolutely see about 50% of the people disagreeing with me right away, but in lieu of doubling down with the pharmaceuticals, mainly the Novo and the Pfizer positions right here, I think the health insurance giants would be a better alternative, such as Humana, Elevance, or even my beloved CVS. Dude, I kind of regret selling out of CVS. I bought into them when they were about like 30, 32 bucks a share. And once they hit 65, I sold them for about 100% gain. I should have just held on to them. But this video is not about me, it's about Bob's portfolio. So I guess I'm just trying to make the argument for health insurance stocks. It's the same sector, just a different category. It's not financial advice, it's just the fun things that I would tell Bob. But to be honest with you, I can understand where Bob is coming from, because if you jump on over to Pfizer's dividend profile, pretty juicy dividend yield. A 7% yield that pays a qualified dividend payout. I can see what he sees, but it's not my cup of tea. I would never invest into them. Now, having said that, the holdings that I would personally keep buying whenever they go on a dip or corrections and increase exposure to are the following. I would double down on NextEra. I would buy more of Rexford, United Health, American States Water, Hershey Company, American Waterworks, PepsiCo, Lockheed Martin, and WEC. And because Bob wants a 7% dividend growth rate as a goal, I would personally add Realty Income Corporation, as you can see right there, ticker symbol O, and the famous tried and true battle-tested SCHD to the mix. I think it would make a ton of sense. So what you see on your screen right now are the modified adjustments that I would make, meaning I would cut the rest, double down on these, and add SCHD and Realty Income. And with those adjustments, it would be valued at $1.07 million, exactly pound for pound what it's valued at today as of this weekend, September the 21st. The asset allocation, I think, is a pretty healthy mix of real estate, utilities, and SCHD. And if we scroll on down, in about 10 years, the projection growth rate of the portfolio's valuation should be $2.1 million if you do nothing else else, if you do not double down, if you don't reinvest the dividends, if you just hold the line, it would grow to 2.1 million in 10 years. And just for fun, in 25 years, it should be 6.3 million. So if you do the math and you check out the 3.5% dividend yield that this portfolio hypothetically would generate, it would keep in line with the rate of inflation. Jumping on over to the dividends section, if we make these adjustments, the goal right now is to get 40 grand. However, right now, on paper, he's generating about $37,000 in dividends. So with those modifications, he would hit his $40,000 a year in dividends goal. And every month, the breakdown would be about $3,300. Every day, roughly $109.62. And the portfolio's yield would be 3.7%. So we're increasing it ever so slightly from 3.48% to 3.72%, and it makes a huge difference, as you can see. And if we look at the breakdown of the dividends paid out, let's just do it like this. Total amount, royalty income would be paying him the most, and it's a monthly dividend stock. $12,300 a year in dividends for the first year. The second biggest one would be Next Era Energy, $5,600. Rexford Industrial, $5,100. SCHD also around $5,000. So it's a pretty diversified mix that I think would add a healthy seasoning into the recipe. And the lowest payout would obviously be Lockheed Martin at $792. The reason why I left them in there is because right now his average cost basis for Lockheed Martin is roughly $416. They can easily go back to $500, $550 within a year or two. So that would bridge the gap for the share price appreciation that he's looking for of about 7%. The modified portfolio's dividend growth rate for the past 5 years has been 8.1% year over year. So it's above his 7% growth rate target. And for the past 1 year, then we're talking about 7.6%. But then again, it's still above the 7% growth rate target. And keeping in line with the portfolio's growth, in about 10 years, the dividend income should shift from $40,000 a year to $129,891. And in 25 years, it should roughly be $1 million in passive income, as long as none of these companies croak, go belly up, or go bankrupt. So overall, I think this portfolio looks pretty darn good. Can we get a round of applause to Bob? Not bad at all, brother. This is pretty good. I am pleasantly surprised and happy that you have a lot of high quality dividend compounders in your portfolio. I think it just goes to show, just because you're 33, you do not have to only invest and chase a portfolio goal of a 40% ROI in a single year by going all out into crypto, AMD, and all of the other speculative growth stocks. It really depends on your goals and retirement strategy. Just because you're 33, it does not mean you need to only do growth. I think a little bit of both would make the most sense, but if you're eyeballing retirement like he is in the next year, I'll go on record by saying it again, I think his portfolio would be a B for that passive income. Now, if you feel like this video was worth about 25 bucks and you want me to roast and review your portfolio, then you can submit your holdings through the Google form that's going to be in the pinned comment or down in the video description. Only 25 bucks, and I'll do the exact same thing for your portfolio. Now, having said that, if you made it to the end, I love you guys. Good luck in the stock market. Stay safe out here. Please, there's crazies. And I will talk to you next time. Peace.